Today, we are doing a deep dive into a book that, you've probably seen it on shelves for decades. It's one of the most dominant personal finance books ever written. Rich Dad, Poor Dad by Robert Kiyosaki, which first came out way back in 1997.
Welcome. And this book, it's really not just a list of financial tips. It's more of a philosophical document. Our mission today is to, cut through all the noise and really analyze its core lessons, the big mindset shift it demands, and importantly, the major criticisms leveled against it. We want to give you the full, balanced picture.
Right, because the whole thing is built around this
Yeah.
powerful story. Kiyosaki uses these two father figures to contrast two totally different ways of thinking about money.
Mm-hmm.
You have his biological dad, the poor dad, highly educated, valued job security, worked for a safe paycheck. And then there's his best friend's dad, the rich dad, who taught these unconventional real-world lessons about how money actually works.
And that contrast leads right to the hook, the central message that got millions of people reading. The poor and the middle class work for money, but the rich make money work for them. It's a huge provocation.
It really is. It basically says that whole corporate ladder you've been taught to climb, it might be leaning against the completely wrong building.
Exactly.
Okay, so let's unpack that. Let's start where he does with redefining the absolute basics. For a lot of people, financial health is all about a high salary. But Kiyosaki just dismisses that idea right away.
He does. He says true financial freedom isn't about your salary. It's about building up assets that generate passive income. And what's fascinating is how he immediately challenges, traditional accounting definitions to make his point.
Okay, so help us with that. Most people would look at their house as their biggest asset, right?
Absolutely. On paper, it is. But Kiyosaki, in Chapter 2, he simplifies everything down to one thing. Cash flow.
Just cash flow.
Just cash flow. An asset, in his world, puts money into your pocket every month. Think rental income, stock dividends, a business. A liability, on the other hand, takes money out. That's your car loan, credit card debt, and yes, the mortgage, taxes, and upkeep on your primary residence.
So even if your house is going up in value, he'd call it a liability because it's costing you money month to month.
Exactly. The goal he sets out is simple. Buy assets, reduce liabilities. You do that until the passive income from your assets covers all your monthly expenses. That's the foundation of his idea of financial independence.
And that reframing leads right into his next big point in Chapter 3, mind your own business, which doesn't mean quit your job.
No, not at all, at least not at first. It means that even if you have a job, your real business is your asset column. You have to focus your energy and your extra money on buying those things. Stocks, bonds, real estate, intellectual property, things that build your wealth separate from your 9 to 5.
Building your balance sheet, not just your income statement.
You got it. And that leads us to the next big strategy, which is about leveraging systems.
Okay, this is where it gets really interesting and maybe a little controversial. He claims the rich pay a lower tax burden than the middle class. How does he say they do that?
Well, the insight in Chapter 4 isn't about, illegal tax evasion. It's about structure. Financial intelligence, he says, is knowing how to use corporate structures to your legal advantage.
And what's the key mechanism there?
It's the sequence of how money flows. For most people, W-2 employees, the sequence is earn, pay taxes, spend. You get your paycheck, taxes are already gone, and you spend what's left.
Right.
But for a business owner, the sequence is earn, spend, then pay taxes. The money comes into the corporation first. They spend it on legitimate business expenses, which can include things that build their assets, and then they pay taxes on whatever profit is left over.
So they're using pre-tax dollars to invest and grow.
Precisely. It's a legal advantage that most employees just don't have access to.
Which brings us to skills. Because to do any of this, you need specific knowledge. In Chapter 6, he tells you not to just chase a higher salary. But that feels a little impractical for someone with a family, a mortgage.
That's a fair challenge, and it's one people raise all the time. He's not saying your salary doesn't matter. His work-to-learn principle is about prioritizing skills that will multiply your wealth over just getting a small pay bump.
And he focuses on 4 specific skills.
Yeah, 4 main ones.
Yep.
Marketing, investing, sales, and communication.
Why those?
Because they're the levers. You can be the best coder or engineer, but if you can't sell your idea, sales and marketing, or explain its value, communication, your income is always capped.
Yeah.
Investing is how you put your money to work in those systems. It all comes back to his core idea. School teaches you to be a good employee. Financial education teaches you to be an owner.
Now, all of this, buying assets, using corporate structures, it all requires taking on something most people avoid at all costs. Risk. He says the rich invent money. What does he actually mean by that? It sounds so dramatic.
It does, but he doesn't mean they're printing it in the basement.
Okay, good.
It means financial creativity. It's about seeing an opportunity that other people miss, structuring a deal, maybe using other people's money, and creating profit out of thin air, essentially. It's about taking calculated risks.
And that fear of risk is what holds most people back.
It's the primary barrier. He says it's not a lack of capital, it's a lack of, well, guts. It's fear. Fear of losing money, fear of what other people will think, fear of failure.
The book actually lays out 5 of these emotional roadblocks in Chapter 7. They're pretty psychological.
Yeah, and he says overcoming them is the real work. The first is fear, which we just talked about. Then there's cynicism, that little voice that says, oh, that'll never work.
I know that voice.
We all do.
Yeah.
Then laziness, which he says is often disguised as being busy. After that, bad habits, like paying all your bills before you pay yourself by investing. And finally, arrogance, thinking you already know everything and refusing to learn.
That point about laziness being disguised as busyness, that's powerful. It's that rat race he talks about, working harder and harder just to afford a bigger house, a nicer car.
Bigger liabilities, exactly. You're mistaking activity for achievement. He argues you need to stop, think, and educate yourself instead of just running faster on the treadmill.
So that psychological framework is a huge part of the book's appeal. But we have to talk about the critics. This raises the big question. Is this philosophy actually practical, or is it, dangerous advice for the average person?
That is the critical pivot we have to make, because the book is great at shifting your mindset, but applying its ideas requires a lot of caution.
Okay, so let's start with the undeniable strengths. Why is this book still a bestseller after all these years?
Well, first, it's incredibly easy to understand. He uses simple stories, not jargon. Second, it's highly motivational. It makes you feel like you can take control of your financial life. And third, the core message, assets versus liabilities, passive income. That's a timeless idea. It's still relevant.
But then there are the counterpoints, the weaknesses, which you really need to understand. I think the most common one is the lack of practical detail. It's all what, but no how.
Precisely. It's a great mindset guide, but it is not a step-by-step manual. You walk away feeling inspired, but you don't have a concrete plan to execute. You don't know what stock to buy or how to analyze a real estate deal.
And then there's the issue of risk. I mean, he seems to glorify risk, doesn't he? Talking about using debt to buy assets. That's terrifying for most people and can go horribly wrong.
That's a huge red flag for many financial advisors. He definitely underplays the reality of losing money. When you use leverage borrowing to invest, your wins are bigger, sure, but your losses can be catastrophic. You could lose everything. Critics say he encourages a kind of recklessness.
And finally, we have to touch on the authenticity concern. The elephant in the room. Was Rich Dad even a real person?
And that matters to a lot of people. If the story is true, it's a powerful testimony. But if Rich Dad is a fictional character, as some critics claim, then the book becomes less of a memoir and more of a financial fable.
Which changes how you read it.
It does. It shifts the narrative from, here's what I did and you can too, to, here's an interesting philosophy to consider. For people looking for a proven blueprint, that ambiguity can be a real problem.
So if we step back and look at the whole picture, what's the final evaluation? It sounds like it scores high on things like motivation and clarity, but maybe not so high on practical usefulness.
That's a perfect summary. It's fundamentally a book about changing your mindset. Its real value is in challenging those traditional, often fear-based beliefs we have about jobs, money, and security. It forces you to stop just trading your time for a paycheck.
It changes the question you ask, not how much do I earn, but what assets am I building?
Exactly. It forces you to look at every dollar and ask, is this building my freedom or is it just another expense? And to leave you with one final thought, a quote that really captures the book's core message. The single most powerful asset we all have is our mind. If it is trained well, it can create enormous wealth.
So that leaves you with a choice to consider. After hearing all this, the good and the bad, which of the two dads' philosophies are you relying on right now? And what's one specific calculated step you could take